Let's get the global out of the way. Steve Bryce is Chief Investment Officer at Standard Chartered Wealth Management. Steve, great to have you with us here. Thank you very much for your time. So U.S. markets are down some 18-19% year to date. Here in India, the equity market in local currency terms is up just a bit, 1.5%, but that is still quite a bit of outperformance relative to what the U.S. is doing. Arguably, things here are much better as well. I mean, inflation is not that big a problem. Domestic growth is chugging along quite nicely so far. What's your sense? Can this continue in your opinion?
So I think you're right in terms of the domestic fundamentals. Obviously, the economic performance looks much more robust from what we're seeing from what's going on in India. Earnings growth looks very healthy as well. Obviously, double-digit earnings growth quite comfortably expected over the coming 12 months. And if you're looking at the policy response, obviously there is uncertainty on that regard in India as there is elsewhere in the world. But the market's probably discounted a reasonable amount of tightening still. So from that perspective, we do think that India will be a bit more resilient going forward. So we're within Asia, we're overweight Asia as well. Although to be fair, that's to a significant extent that is a China sort of reflation play that's obviously it's taking longer than we anticipated to come through. But we're overweight Asia, but within that we're also overweight the Indian market as well, based on those factors. It's not going to be smooth sailing. I think we've seen that in recent times. But overall, we're still bullish on the Indian market and expect further outperformance going forward.
Steve, hi, good morning. So the Indian market outperformance, it's already been there, and now we are trading at almost record, premium in terms of the valuations. We always traded at premium, but this is now record premium. So do you guess that could perhaps make the market into a bit of a dangerous territory?
So clearly, it is the sort of the toughest part of the story, if you like, when you're looking forward. I mean, obviously, as you sort of inferred, the market does generally trade at a premium to other markets around the region. But it is very high now, the valuation. So we really do need to see that earnings growth coming through. And if there were disappointments, clearly that would lead to some significant short-term volatility. So the way we're playing this is generally that from a sectoral perspective, we're overweight sort of the more cyclical areas of the market. So we're overweight industrials and consumer discretionary, for instance, where we see the growth drivers as being more significant and more robust going forward.